For anyone in crypto, there's a lot to learn from how Wall Street crooks move money. The funny part? Most of those tricks weren't even invented for crypto. They were made for traditional finance. And the wild thing is, they still work today if you know how to use them. Now, most people only know Jeffrey Epstein for the horrible crimes he committed, but the reason the elite kept him around wasn't that. It was because he knew how to move money, clean it up, and hide it better than almost anyone alive. And here's the truth. The rich play this game every single day. They don't just stash their money under a mattress. They use tools that make it look legit, pass audits, and even cut their tax bills. So in the next few minutes, I'm going to break down some of those tools, not so you can do anything shady, but so you understand how the rich play the game, and how some of those same moves could help crypto investors turn a messy pile of coins into something banks will actually accept. Think about it like this. You walk into a room in a cheap t-shirt. No one notices you. Put on a sharp suit, suddenly everyone treats you differently. Wall Street figured this out decades ago, but instead of suits, they used complicated contracts and legal tricks. They took some of the dirtiest money in history and dressed it up with fancy names like options trading, mirror trading, and credit default swaps. Let's break them down in plain English. 1. Options trading, the side bet trick. Options are basically side bets on where the price of something like Bitcoin is headed. You're not buying the coin itself, you're buying the right to buy or sell it later at a certain price. Call option, betting the price goes up. Put option, betting it goes down. Now here's the Wall Street twist. Let's say Bitcoin is $120 right now. You place a bet you can buy it later at $150K. Nobody in their right mind would take that today. It's already $30K or cheaper. That's called an out-of-the-money bet, normally useless. But here's the play. You set up two companies, Company A and Company B, and you secretly own both. Company B holds your messy Bitcoin, the kind without a paper trail. Company A sells one of these wild bets to Company B. And boom, suddenly Company B has a legit receipt for where its Bitcoin went. Banks love receipts. Of course, the bet expires worthless. Bitcoin probably won't hit 400 CALR by next month. But that doesn't matter. On paper, it looks like a normal risky trade. To the IRS, it's a loss you can write off. To the bank, it's clean documentation. That's why this method is so powerful. Mirror trading, the shell game trick. This one's old school. Big banks used it for years to move money across borders. The idea is simple. Shift profits from a country with high taxes to one with little or no taxes. Imagine you bought Bitcoin years ago. If you sold today, you'd owe a mountain of taxes. Instead, here's the workaround. Your U.S. company sells Bitcoin to your offshore company, which you also control. But you sell it cheaper. Say Bitcoin's on $20K, but you sell it for $100K. On U.S. books, that's a $20 loss. Less taxes. Meanwhile, your offshore company now holds Bitcoin at a discount. And since it pays no taxes, it's chilling. Boom. You just moved your wealth offshore and shaved your tax bill. The catch? On public exchanges, bots will instantly grab your low sell order. So you've got to do this privately, through over-the-counter trades where you control both sides. That's exactly what Deutsche Bank got caught doing with billions coming out of Russia. And if an auditor asks why you sold below market, easy story. Exchanges rejected my coins, so I had no choice but to do a private deal. Credit default swaps, the insurance trick. This one sounds complicated, but think of it like fake insurance between two of your own companies. Company A licenses something, like software or branding, to Company B. Company B pays regular fees. Normal so far. But then Company B decides to pay with something risky, like a sketchy stablecoin. Company A says, "Whoa, that looks unstable. I want insurance in case it collapses." So Company B pays extra premiums to Company A. Those premiums are income for A, clean receipts, and expenses for B, lower taxes. If that coin collapses like Terra Luna did, the contract pays out a lump sum. On paper, it looks like smart risk management. In reality, it's just moving money around with paperwork that banks can't argue with. The big picture. Here's what ties it all together. Wall Street doesn't really move coins around. They move contracts. Fancy paperwork that makes dirty money look clean. To outsiders, it's too complicated to question. To insiders, it's just business as usual. For crypto investors, the lesson isn't to copy shady tricks. It's to realize that if you want to play in the big leagues, you need receipts. And those receipts can be built using the same financial tools the elite already use. At the end of the day, it's a big club. The banks, the billionaires, the hedge funds, they're all playing with the same playbook. The only question is, are you going to keep watching from the stands, or are you ready to step onto the field with the same gear?